Have you ever wondered why so many people jump into the real estate business, buy their first property, tell everyone about the incredible deal they found, only to realize months or later that the deal they thought was amazing actually was not a good deal at all? Why does that happen? Well, in most cases, it's not because they were lazy. It's not because they didn't put in enough effort. The problem was they didn't analyze the deal properly. They made guesses and they made assumptions without testing and challenging those assumptions enough. And it resulted in them having more optimistic assumptions than reality actually reflected, which caused their deal that they thought was great to turn out much worse than they had hoped and planned. And so today I'm going to show you how to prevent that from happening. And by the end of this video, you're going to be able to look at any property and quickly decide, is this a deal that I should look into, or is this, I can already tell, a terrible deal that we're going to move on from immediately and not waste your time underwriting deals that were never going to make sense to buy in the first place? So let's start by talking about a cap rate. What is a cap rate? In the simplest terms possible, a cap rate tells you how much money a property generates relative to the price you're paying for it. That's it. It's that simple. It answers one simple question. If I bought this property with all cash, how much money would I make every year? The cap rate doesn't factor for your loan. It doesn't factor for capital expenditures. It's just, what did I buy it for? And if I bought it all cash with no loan, no interest, what would I make per year? To calculate a cap rate, it's a simple formula. The cap rate is the net operating income divided by the purchase price. Net operating income is what the property generates from operations after you collect rents and pay expenses. So you have rental income, then you have property taxes, you have insurance, maintenance, property management. What is left over is your net operating income. It does not include your mortgage. Mortgage is a below the line expense, meaning below the NOI line on an income statement. And so that's a mistake beginners can make. They think that net operating income is their profit after their loan. Not the case. It's your profit before your loan payments. And so let's walk through a quick and simple example to illustrate cap rates. Let's say you're looking at a property that costs $1 million to buy. And every month, the property generates $7,500 in rent. That's $90,000 a year in rental income. Now let's subtract expenses. Let's say you've got $15,000 in property taxes, $5,000 in insurance, and $10,000 in maintenance and other miscellaneous expenses. That's $30,000 in total expenses. So to calculate your NOI, you take that $90,000 in rental income and you'd subtract $30,000 in operating expenses. And so your NOI is $60,000. And then to calculate the cap rate, you take that $60,000 in net operating income divided by the $1 million price, and that equals 0.06 or 6%, and that's your cap rate, 6%. And so what does that mean? It means if you bought the property for $1 million in cash, you would make a 6% annual return on that money. In this example, $60,000. $60,000 is 6% of your $1 million purchase price. And so what is a good cap rate? And the answer is it depends. And this is where beginners really get tripped up a lot. They think that whether a deal is good or bad depends on the cap rate when they bought the deal. And whether a deal is going to go well for you or not has nothing to do with the cap rate day one. And it has everything to do with what happens to the income of the property after you buy it. Are you decreasing vacancy, or is vacancy increasing? Are you pushing rents higher, or are rents going down? Are you operating the property more efficiently than it was when you bought it, or are you operating the property less efficiently? And so if you buy a property at a 10% cap rate, which is a very strong return, 10% a year, and you operate the property poorly, you have a bunch of vacancy come up that you don't know how to solve for, your 10% return when you bought the property could turn into a huge loss. And so smart investors are thinking solely about where they are going to take the income and the returns after they buy it, not what it is day one. And they decide whether it's a good deal or not by saying, once I execute my business plan, what is my income going to be, and what is my total cost from when I purchased the property, and then any capital I invested in the property to execute my business plan, to increase rents, to decrease vacancy. And they look at their income, their total basis, everything they put into the property, and then they look at what is that return, and is that return in line with my expectations of what I need to make money for myself and my investors, and how likely do I think it is I'm going to be able to execute that business plan? Do I have to push rents higher than what the market comps currently say? Do I have to have super aggressive leasing assumptions in terms of how quickly spaces are going to lease, how much free rent I'm going to have to give? And smart investors know that unexpected things happen that are out of your control, and they base their assumptions around what they are confident they're going to be able to achieve based on market knowledge and experience operating properties. And so forget trying to understand if a deal is a good cap rate or a bad cap rate, and seek to understand, what is my return going to be after I execute? What did I have to spend to get those returns? And what is it going to take for me to actually make that happen? And keep in mind that cap rates only apply to occupied real estate, and it doesn't apply to real estate that's vacant. And so if you think about it, cap rate is based on the net operating income. If you're buying a vacant property, there is no income. And so you can't calculate a cap rate. There's no such thing. And so that doesn't mean it's a bad deal, because if you buy a vacant property for a very low price, and then you're able to get a tenant in there that signs a long-term lease, and you're able to sell that building to an investor that's looking for income and doesn't want to have to deal with the work and risk that comes along with buying a vacant property, finding a tenant, giving them money for build out, negotiating free rent and build out timelines. They just want to buy a property that's cash flowing the day they buy it. You can make a lot of money on that deal if you play your cards right, even though there was no cap rate the day you bought it. And so the big takeaway is this: cap rates are a way to quickly filter through deals. If you're looking at vacant deals, the cap rate is irrelevant. And if you're looking at occupied deals, as you get to know a market really well, you're going to get a feel for which types of buildings sell for what cap rates, and you're going to be able to see what the cap rate is based on the asking price a building is listed for. You're going to know what you would do with the property after you owned it, and you will immediately be able to gauge whether the seller is realistic or not. And time is your most valuable resource. So by knowing when a seller is unrealistic, you can immediately move on and look for sellers that are realistic, so that you don't waste all your time underwriting deals that the seller wants double what it's worth. Now, if you've made it this far in the video, you're already ahead of 95% of your competition out there. And if you want to go deeper, be sure to hit the subscribe button. We're always releasing new videos educating people about commercial real estate. Thank you for joining us. We'll see you on the next one.